Okay, welcome to another video, and in this edition we are going to be looking at the weekly macro themes report for the 29th of September, so from a couple of weeks ago. It's a report that goes out to clients of top-down charts, so this is giving you a bit of an insight into what you might get should you want to join us. And today I'm going to be talking through topic number 5, US dollar. Very much intertwined with topic number 4 there, actually, emerging market risks. So straight into it. 5, US dollar outlook. So just a note on format. This is the way it's done. It's in a sort of a PowerPoint format. I've got a bit of a write-up discussing the story there, and then the bottom line, which I'll get to in a second, and then a series of charts that back it up. And the charts cover anything from technicals through to fundamentals, you know, like positioning, valuation, and, you know, more traditional aspects like yields, etc. Anyway, bottom line is this. Tactically, there is upside risk for the US dollar as yield support remains. Futures positioning looks stretched to the short side, and breadth is oversold. And to add to that, seasonality is at this stage of the year turning positive. So let's look at the charts, because this is top-down charts and it's all about the charts. So the first two here are pretty much, you know, really your traditional bread and butter indicators for currencies. So we've got the yield support indicator here. On this one, I've actually made it as a composite, so we're looking at a Z-score, and that combines the nominal, real, and shadow cash rate differentials, as well as 10-year bond yield differentials. So really trying to capture the, you know, all the sort of flora and fauna of yield support for the US dollar. And the bottom line is that it remains at very, very high levels. Now, the first thing that most astute observers will note is that, you know, potentially it is at a point where, you know, you'd see it peak, and you know, looking at the mid 2000s, that's kind of a you know, a lesson or a parallel in that respect. Of course, if you look at the late 90s, it got up to that level, peaked, and then sort of stayed at that level and helped drive, you know, along with various other factors, helped drive that sort of final wave up in the currency. So anyway, you know, I think that that yield support is one of the sort of key underlying fundamental indicators, and that gives you, you know, probably a key background context. It's not a trading indicator by itself, but it's a key piece of background context. One to the right, though, is more of a trading indicator, that's speculative futures positioning. And so, you know, if you look at these two in combination, it can be very powerful. And if you look here, you know, you can see the red line is Dixie futures, so US dollar futures, US dollar index futures rather. And you can see that that by itself has gone below the zero line in terms of net speculative futures positioning. So this is just number of contracts there, I believe. And then the one in the blue line is aggregating it across all of the currency pairs, all the futures, you know, against the US dollar. And you can see there that it's very much stretched to the downside. So, you know, when you see things stretched to the downside, you know, it means two things. First of all, it means sentiment's at an extreme, and you always want to pay attention when you see that. The other thing is, you know, of course, these shorts, if they feel compelled, perhaps by price or other reason, to close out their positions, then, you know, they need to get into the market and start buying. So it's potential buying power as well. On to the next set of charts. So, you know, really just going for those points that I talked about at the start. This one is on the left, breadth. So this is breadth of the US dollar index against the G10 currencies, and you can see that it's 200-day moving average breadth, so percentage of those that are trading above their 200-day moving average, and you can see that it got to extreme oversold levels there. And most importantly, for, you know, an oversold signal, it turned up. So, you know, very much just interpreting it as a textbook would tell you to. You know, if you go and study the CMT program, this is exactly the kind of thing that they'd be telling you to look for. So, you know, all else equal, that raises the odds of at least a short-term bounce of some magnitude. And as I mentioned before, seasonality. So we're just heading into the seasonally strong patch here that tends to emerge through sort of mid-October, November into early December. And, this is across, relatively reasonable period there. And I mean, seasonality does break down and not work sometimes, but, when you're adding it to the mix of an oversold breadth signal, extreme shorts, continuing yield support, it's the kind of setup that looks, at least the risks to the upside is pretty compelling. And, if you're on the short side of the US dollar story, then, you'd at least want to be taking this set of indicators into account from a risk management standpoint. And certainly, as I noted, from emerging market standpoint, the US dollar really is the key variable there. And so just very briefly looking at this emerging markets chart, you can see that black line is the US dollar. With that US dollar coming down, that's taking the pressure off a lot of risk pricing metrics there. So you can see economic policy uncertainties come down with the US dollar. Credit spreads, so sovereign CDS have come down and corporate credit spreads have come down as well. So, from an emerging market positioning standpoint, if you do get a tick up in the US dollar, it's an appreciable one, then that's going to potentially unwind some of those positive dynamics that have been playing out in emerging markets. And so just on to the final two charts, I guess just a final little piece of context. If seasonality was something that you put on after you add into the mix after you look at these more traditional indicators, then analog charts is something that you look at the very end. And analog charts are probably, the weakest form of analysis, but, I think looking at this chart though, and, looking at beyond the fact that, they kind of look like each other, there's actually a lot of macro parallels between those two environments. From a stock market perspective, certainly at a very, very familiar point. And, from a monetary policy standpoint too. And the fact that, this dip down here, sort of 98, 99, there was a bit of, commodity crash at that point as well, which is what we got around this period here in our current times. So I think that there's actually a lot of macro parallels there. So, you could point to that as saying that yes, indeed, there is, a material bit of upside potentially left to come. And, if the analog did play out precisely, well, let's forget that word precisely. Let's say it did make another 10 to 20% upside. That would turn a lot of markets on their head. That would result in some, big winners and losers in the hedge fund managed funds space. So, it's definitely something that that is well worth considering. And finally, there, just on the euro, I mean, considering the US dollar index, I mean, it's not just the euro, but the euro is a major component. And euro, as you would imagine, based on that positioning chart before, for the euro, speculative futures positioning is now stretched to the long side. Back at the start of the year, I did actually point this out here, where we had, quite an extreme undervaluation signal, as well as, significant net shorts. I didn't really bang the table about that one, but I certainly highlighted that in this actual report. And that was actually a pretty good call in hindsight. But at this point, that valuation signal has weakened notably versus then, and and again the positioning has turned around. So I would say that overall looks like the seasons could play out as per usual. And then of course, October, we've got the Fed starting quantitative tightening this month, passive quantitative tightening. So just a sort of a stopping its reinvestment of principal, and monetary policy is, well, it's one of the key drivers for currencies. Currency will often discount the monetary policy moves in advance. But, you know, I guess if there's any skepticism around the Fed continuing with quantitative tightening, rate hikes, I mean, that skepticism will probably be, you know, disappointed, because they're almost certainly going to hike rates again in December, and you know they've already started with quantitative tightening, and you know there's a well telegraphed system in place for progressing that quantitative tightening as time goes on. So, you know, very interesting setup. And you know, just revisiting again that bottom line, tactically there is upside risk for the US dollar as yield support remains, which we saw. Futures positioning looks stretched to the short side for the US dollar. Breadth is oversold, and seasonality is turned positive. So I'm going to leave it at that. If you've got any comments, questions, other views, please do go ahead and put them into the YouTube comment section. And other than that, yeah, subscribe to the channel if you like this video. We'll be doing more of that.